What's up everybody, I am Jaspreet Singh and the Federal Reserve Bank just admitted that a recession is coming. First it was because of Russia and the oil crisis, and then it became a bigger issue of interest rates and rate hikes. And now it looks like the big banks agree. In the first week of April, Deutsche Bank was the first bank to say that a recession is imminent. Deutsche Bank says that we're gonna see a recession in 2023 because of the rising interest rates. And Bank of America agrees. Bank of America says that we're going to see a recession shock because the Fed is going to be working aggressively to reduce the size of the balance sheet. The Federal Reserve Bank is changing some of their policies because now they're really starting to get worried about, well, inflation. And so in order to fight this inflation, the Federal Reserve Bank is doing two things. First, they're raising interest rates, which makes borrowing money more expensive. And second, they want to reduce the size of their balance sheets, which means that they're essentially going to start burning money. So both of these things slow down the economy, but they need to be done if you want to fight this inflation problem that we're facing right now. We've only begun raising interest rates in 2022. And the reason why this is so interesting is because in 2021, the Fed refused to raise interest rates because they said that they don't want to raise interest rates and start fighting inflation until the economy is robust and until the economy can sustain higher interest rates. Now here we are in the second quarter of 2022. The Fed has just started to raise interest rates and everybody is worried about this coming recession. So the Fed originally didn't want to raise interest rates until the economy was strong enough to withstand higher interest rates. Now here we are, the Fed has started to raise interest rates and it turns out the economy wasn't strong enough yet. So the Fed can do one of two things. Either they can say, well, we care about the economy more than we care about inflation, and they don't continue raising interest rates, which makes the inflation problem worse, or the Fed continues to fight inflation, which is what they're saying that they want to do right now, which means that it's going to hurt the economy. Now, to understand the economy, you have to look at three different things. You have to look at incomes, you have to look at the job market, and you have to look at growth. Now, typically, I would write these things down on my whiteboard, but right now I'm in San Diego. I relocated here for a little while. I'm gonna be in San Diego for a couple months, and my whiteboard hasn't arrived yet. So bear with me today as we get through today's video without a whiteboard. And if you are a creator and you're in San Diego, reach out to me. I would love to connect. And the easiest way to do that is just leave me a comment below. Let's start by talking about incomes, because in 2021, we saw incomes grow by around 4.5%. Now, typically that would be considered really good. 4.5% income growth across the country on average is pretty good, but when you compare that to the average inflation of around 8% that we saw in the last 12 months or so, now that wage growth doesn't look so good. And the 8% inflation that I'm talking about is just the CPI data. This is what's reported, but the actual inflation that so many people feel is way more than 8%. I mean, if you don't believe me, just look at your rent payments or housing costs or grocery costs. So for number one, incomes are growing, but not fast enough to keep up with inflation, which is not so good news. So income gets an X. Then if we move on to number two, the job market, at first glance, the job market looks great because we have some of the lowest unemployment numbers in the history of time. Now, the strange thing about the job market is although we have such a low unemployment number, we have a lot of job openings. Like, we have millions of job openings around the country right now, and companies cannot fill their need for this work because there aren't that many people looking for these jobs. Part of the reason for that has to do with the Great Resignation, because you have a lot of people that are changing their careers, wanting to do something that actually makes them happy. Part of the reason for this is the growth in side hustles, because now people are starting to create their own incomes. That way now they can work off of their own schedules. And part of the reason is we just have a new era of millionaires that were born because of the pandemic. Some people became incredibly rich because of meme stocks. Some people became incredibly rich because of cryptocurrency. And so some of these people just don't need to work like they did before because they were able to get wealthy because of things that happened during the pandemic. Now, while YOLOing your money might make some people rich, it is the exception, not the rule. If you really want to build wealth through these things, make sure you're investing your money, not just blindly throwing your money, hoping to blindly get rich by throwing your money into the next meme stock. It also goes for cryptocurrency. I invest my money in cryptocurrency, but you have to understand what you're investing your money in. That's the key to making money with really anything as an investor. You have to know where you're putting your money, and that also means how you're investing your money. Use a reputable brokerage if you're investing your money in cryptocurrency. And if you're looking for an easy to use and cost-effective brokerage to trade cryptocurrency, you should check out our sponsor, FTX US. FTX has made it so simple for anybody to go out and start passively investing their money in cryptocurrency. So let me show you. If you wanted to buy Bitcoin, all you have to do is push a few buttons, and then you can choose. You want to buy it one time, or you can pick your frequency and how often do you want to buy Bitcoin or whatever cryptocurrency that you want. This way you can set up a dollar cost average system so you can buy cryptocurrency every day, every week, every month. I buy cryptocurrency every single day, and FTX makes it so simple to do that. And the fees on FTX are so much cheaper than all the other major brokerages. So now when you're buying cryptocurrency, you can have more of your money going to your actual cryptocurrency instead of just making your brokerage richer. Part of the reason for that is the CEO and founder of FTX has a big altruistic motive. You can trade cryptocurrencies, you can buy and sell NFTs, and I just heard that they're also going to be launching a new feature where you can buy and sell stocks right off of their app. And the best part of all is that FTX is giving you a free coin when you trade $10. All you have to do is use my link down in the description below, and then you have to enter in the referral code minority. I'll write it on the screen here. So all you got to do is click my link down in the description, enter the referral code minority, and then you get a free coin from our sponsor FTX. So income gets an X and the job market gets a check mark, because right now the power is in the hand of the employees, not the companies. And this is where things get really interesting with number 3, growth. Because our economy runs on spending. The more money you spend, the more money somebody else makes. If I have $100 in my pocket and I go to the restaurant and I spend my $100, now the restaurant makes $100. They have more money that they can use to hire more employees. They have more money to invest in new products. They have more money to invest in new stores. So the more money that people spend, the more money the other people make, and the more money the other people make, the more money that can be reinvested back into our economy. Now, this is where you have to go back to understand income. Because when income is not keeping up with inflation, well, then it's harder for people to keep up with spending. Because if inflation is 8% a year and incomes are only growing by 4.5% a year, that means that life is getting more expensive than your pay raise. You got a pay raise, but it's not enough to keep up with the higher cost of living. That means in order to maintain your cost of living, either you're gonna have to go into debt or you're gonna have to downsize. And that's what we're seeing happen. You're gonna have to downsize. Now, people were able to subsidize the cost of living because of the help of low interest rates. So you had inflation up here, wages that weren't keeping up. This caused a little discrepancy. But then you had super low interest rates. We had super low mortgage rates. And so people were able to go out and borrow more money and borrow more dollars and spend more dollars because it was just so cheap to borrow money. And this made up for this gap. So people were able to borrow more money and spend more money because now you can go out and buy a bigger home. You can refinance cash out of your home and have more money to spend. You saw credit card debt rise because people didn't feel it was as expensive. You saw the growth of buy now, pay later systems. So people were able to subsidize this higher cost of living even though wages weren't keeping up with debt. That's why in 2021 we saw such a fast growing economy, because our growth was fueled by cheap and easy debt. And now in 2022 people are getting worried because we don't have that same access to the cheap and easy debt because the Fed wants to raise interest rates more aggressively. The easiest way to understand this is just to think about the housing market. When mortgage rates are 3%, you can borrow $500,000 and your payments are only $2,100 a month. But if you borrow that same $500,000 and now your mortgage rate isn't 3%, it's 8%, now that same $500,000 is going to cost you $3,700 a month. The person who borrowed the $500,000 when it was just 3% a year isn't the same person borrowing the $500,000 when it's 8% a year. And so when it becomes more expensive to borrow money, people are going to have less options to spend, which means spending slows down, which ultimately slows down the economy. That means if interest rates continue to rise and the Fed does what they actually say that they're going to do, which is continue to fight inflation and continue to raise interest rates aggressively, if the Fed does that, you're going to see a slowdown in the housing market over the next 12 to 18 months. Remember, things have a lag time. This isn't something that happens overnight. This isn't something that happens over the next 30 to 60 days. This takes time. Now, you're going to start to see the impacts rather quickly, but the real costs and economic impacts are going to take time to really build. So over the next year and 18 months, you're going to see a slowdown in the housing market because people won't be able to buy homes like they could before because it'll be more expensive to buy a home. And that also means you're going to see an impact on business because you have a lot of businesses that relied on this cheap and easy debt to grow. And one of the things that happened was you saw a big boom in your startup, tech, momentum companies, because a lot of these companies relied on funding from external sources. You have a lot of companies that were not profitable that were able to grow to multi-billion-dollar valuations because there was cheap and easy debt. Uber was a big example of this, which worked out in the positive direction. And then you have some companies which are really struggling now, like Peloton and WeWork, which were also examples of this more on the negative side. But these companies were not profitable, but they were able to raise so much money because you had these venture capital firms that were able to borrow money for super cheap. And if you can borrow money for 3 or 4% a year, you only have to grow it by 5% a year to be profitable. And so you had these venture capital companies that were throwing millions and millions and millions of dollars into companies because they didn't need to see a huge return, but they could push their companies to grow by 10 to 20 to 30% a year. So if you can borrow $100 million at 4% a year, and you can grow your money by 20% a year, well, now you're getting a pretty big return on your money. That's what so many of these venture capital firms were doing. And now as interest rates go up, it becomes more expensive to borrow money, which means these startup momentum companies are going to need to start showing some profits. That way they can continue to stay in operation. But remember, there's a big if here, because all of this depends on if the Fed continues to raise interest rates. Because if the Fed says that the economy is starting to get hurt, or that the war overseas is getting worse, or that something else is happening, and so the Fed can no longer keep raising interest rates, then you'll just start to see more inflation again. And then to top it all off, you have oil, because you had a survey by the Federal Reserve Bank out in Dallas, Texas, and they said that because of all the issues happening with Russia and Russia's oil no longer coming into the United States, it's inevitable that we're gonna go into a recession, according to their survey by these economists. Now, if you've been subscribed to the Minority Mindset, you already know that oil prices affect pretty much everything, because when oil prices go up, gas becomes more expensive, it becomes more expensive to go on vacation, it becomes more expensive to buy groceries because you need trucks and other transportation to take your groceries from the farm to the store. So as oil prices go up, everything becomes more expensive, which ultimately hurts spending, because when people have less money to spend, then that slows down the economy. And the Fed survey also pointed at history, because the 1991 recession was caused by the 1990 invasion of Iraq and Kuwait, which set off an oil crisis, and that resulted in a recession which started in 1991. So now that you have all this information, what do? Well, the first thing is now you're aware, so you have to start doing some things with your money. That means first, you need to start putting some cash aside. You want to have some cash aside for emergencies. I know it's a weird time to be saving money, especially when you're in such a high inflationary environment, but you want to have an emergency fund just in case of anything. So you want to have some sort of cash put aside, and then you want to have cash put aside for investments. You want to have money to buy investments if we see asset prices go down, if real estate prices go down, cryptocurrency prices go down, or stock prices go down. You want to have some cash to buy. And then what I do is I also have a passive investing system. I talked about this earlier in the video, where I passively invest my money into cryptocurrency. I also passively invest my money into the stock market, and I also passively invest my money into physical gold. Start creating some dollar cost average system, because for me, every month, I'm always buying more of these assets, and if stock prices and asset prices go down, I'm still buying. And if they go up, I'm still buying. I'm trying to accumulate shares in all of these things. So start investing your money, because whether we go up or down, you want to make sure that you can continually build up your share of these assets. And we're going to see a lot of volatility, at least through the next 12 to 18 months. And so if you want to prepare for that, you can have some cash put aside. That way, if we see a big dip, then you can come in and buy. But you also want to have some passive system, because nobody can perfectly time the market. Nobody knows when we're going to hit the bottom. Nobody knows if or when we're going to hit a recession. Nobody knows what the Fed is going to do. So instead of trying to guess that, create a passive system and then have some extra cash. That way, if things do go down and you see a crash in asset prices, that's when you can come in and buy. If you enjoyed this video, here's a video on why the face of America will never be the same. And while you're at it, you can subscribe to Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and as always, keep hustling. People are willing to take a pay cut if they don't have to go into the office, because that means you can have a better quality of life, because now you can pick your hours,